Most indicators are noise, but after trading for over a decade, these are the best 5 indicators that every trader should use, especially when trading pre-market and after hours. The most important indicator that I use in trading volatile pre-market and after hours periods is the one that for some reason not a lot of traders focus on. It's called ATR. The biggest mistake traders make is using the same stop size on every asset. They'll use a 2% stop on Nvidia, a 2% stop on Bitcoin, and then a 2% stop on some micro cap, and then wonder why one trade barely moves while the other gets stopped instantly. ATR fixes that. ATR, or average true range, is not as talked about as indicators like RSI, MACD, moving averages, all of which I'll talk about in a second. But from a trade execution standpoint, it's extremely important. ATR tells you how much an asset normally moves. Now that matters because raw percentage moves are pretty meaningless without context. A 3% move in Nvidia might be huge, but a 3% move in some volatile microcap or meme stock might be completely normal noise. This is especially important pre-market and after hours because the market can move fast, spreads can be wider, and candles look way more dramatic. If ATR is high, the asset is moving more. That means your stop probably needs to be wider, but your position size also needs to be smaller in order to maintain your own risk levels. If ATR is low, the asset is calmer. Your stop can be tighter and your position size can potentially be larger. Using ATR effectively is about maintaining constant risk. You should not risk more just because the asset is more volatile. I also use ATR to judge momentum. Don't just ask, did the asset move 10%? Ask, did the asset move 10% when its normal range is actually 9%? Or did it move 10% when its normal range is actually 2%? Those are very different signals, especially when you're trading pre-market and after hours and the swings tend to be a lot bigger. What I like about ATR is that it turns volatility into a framework, and it helps me avoid random stops, random sizing, and helps me maintain my risk parameters regardless of the asset. The most commonly used indicator is the simple moving average. But from what I've seen a lot of traders misunderstand is that they just don't understand its purpose. Moving averages are not really about predicting anything, even though that would be very nice. Moving averages simply answer one question. Are you trading with the trend or are you trading against it? Remember, the trend is your friend. The two moving averages that tend to be used most often are the 50-day and 200-day moving average. The difference between the two is that the 50-day moving average tracks the intermediate term trend by responding quickly to price changes, while the 200-day moving average reflects the long-term trend and changes at a slower pace to help filter out short-term market noise. If the price is above the 50-day and above the 200-day moving average, and those moving averages are sloping up, that usually tells you the broader structure is healthy and the trend is bullish. In this type of environment, long signals deserve more attention. Pullbacks are more interesting because they allow you to get in at a discounted price, and breakouts are more believable. If the price is below the major moving average levels and those moving averages are sloping down, this can signal a bearish trend. In a bearish trend, buying the dip becomes dangerous. Bounces are more suspicious, and setups start to matter a lot more because trading in the direction of the trend generally offers better odds than fighting against it. Moving averages really matter for pre-market and after-hours trading because these time periods can be a lot more volatile than typical trading hours. There's usually a lot less liquidity, spreads can be wider, one late earnings call or headline can move an asset way more and way more aggressively than it would during normal market hours. Moving averages help here because they can help you track underlying trends and help separate a real move in the market from a move based on pure panic. Now, you might have heard about a golden cross or a death cross, and beginners sometimes treat moving average crosses like automatic buy or sell signals, but they're not. A golden cross is a chart pattern that means short-term trend is improving relative to the long-term trend. It's basically telling you an asset is trending upward. And a death cross is a chart pattern that means the exact opposite. It's kind of like a warning sign that the asset is trending downward. Just keep in mind that both are lagging signals. So by the time they trigger, a lot of the move has actually already happened, which, by the way, isn't necessarily a bad thing since it can help filter out noise. So with that being said, a golden cross does not mean a buy immediately, and a death cross does not mean sell everything. They're simply showing overall trends. Now, when a cross happens, the question to ask isn't, should I buy or sell? It's whether the market is in an environment when a trend can actually develop and sustain. A cross that emerges from a long, quiet consolidation can mark a start of a powerful new trend, and a cross in a market that keeps chopping sideways will usually just whipsaw you. In a clean and more predictable trend, moving averages can be incredibly useful. In chop or in an unpredictable market, they can be terrible. So you should use moving averages as more of a trend filter and always use them in combination with market regime and sector character to determine what type of market you're in and how sustained the trend actually is. Now, I talk about market regime and sector character along with other retail trading basics in an upcoming video on trading strategies for bull, bear, and sideways markets, so subscribe and turn on notifications. Another foundational indicator that is commonly used is called MACD. MACD, or Moving Average Convergence Divergence, is basically a momentum and trend hybrid indicator. It helps tell you if momentum is building in the direction of the trend or if the trend is actually starting to fade. There are a few components to the MACD indicator to pay attention to. You've got the MACD line, the signal line, the histogram, and the zero line. When the MACD line crosses above the signal line, that shows bullish momentum picking up. When it crosses below, that means bearish momentum is picking up. Now, when the histogram expands, momentum is rising. And when the histogram shrinks, momentum is fading. But with MACD, just like with moving averages, crossovers matter way more in trending markets than they do in choppy and unpredictable markets. In an uptrend, a bullish MACD crossover after a pullback can be really useful confirmation that momentum is picking back up. Similarly, in a downtrend, a bearish MACD crossover after a bounce can tell you that downside momentum is accelerating. But in a choppy market, MACD crossovers can be a trap. So the rule with MACD is that you should always check the market regime and see how the asset is performing against similar assets in its sector and the larger market as a whole. If the asset is trending, MACD can help confirm entries. But if the asset is chopping, MACD is mostly noise. Cutting through that noise becomes especially useful in pre-market and after hours because it helps cut through the drastic reactionary moves. MACD confirms whether momentum is really building rather than just reacting to a single spike that could cause you to chase a move that won't hold. RSI, or Relative Strength Index, is one of the most abused indicators in trading. Beginners tend to learn that RSI above 70 means the asset is overbought, and RSI below 30 means that the asset is oversold. So above 70, they short it. Below 30, they buy it or go long. If you're using RSI like that, it's time to stop now. RSI measures the speed and magnitude of recent price changes to evaluate whether an asset is overbought or oversold. It tells you whether a move is gaining strength, getting stretched, or starting to lose momentum. If an asset is trading within a range, the 70 and 30 levels can actually really matter. If price is near resistance and RSI is stretched, that can be useful. If price is near support and RSI is washed out, that can also be useful. But keep in mind that in a strong trend, RSI can stay overbought or oversold for a long time. So if the market is more risk on and the asset sector is in a strong uptrend, just because the RSI is signaling overbought, that doesn't mean that there isn't still a lot more room for the asset to run. Similarly, just because an asset is oversold doesn't mean that the asset can't keep bleeding lower, especially if there's a strong downtrend. With RSI, I focus on RSI divergence because it can warn you that momentum is fading before the price itself starts to reverse. Divergence means that if the price is making a higher high, but RSI is making a lower high, that tells you the momentum is not confirming the move anymore. That does not mean that you should short immediately though. It means that the move is getting weaker, so you should pay attention a little bit more. Same thing on the downside. If price makes a lower low, but RSI is making a higher low, pressure might be fading. I also like watching RSI against its own moving average. When RSI crosses above its moving average, momentum may be turning up. When it crosses below the moving average, momentum may be turning down. But again, context matters. In an uptrend, I care less about RSI being overbought and more about whether RSI pullbacks hold higher levels. In a downtrend, I care less about RSI being oversold and more about whether bounces are weak. In a chop market, RSI can help you fade range extremes, but only if you're pairing it with support and resistance levels. And in 24/7 markets, this matters even more because momentum doesn't always get a clean overnight reset. So raw 70-30 readings can actually be a lot less useful by themselves. So when using RSI in the context of 24/7 markets, I rather use at longer lookbacks, divergences, and market structure to determine my move. So just to recap, RSI is not a buy button below 30 or a sell button above 70. It's a momentum tool. The last indicator you want to focus on is volume. It's easy to dismiss volume as a confirmation tool or as a bonus check mark, but in reality, it might be the single most important indicator in trading because it reveals how much conviction is behind a price move. Volume tells us whether a move has real participation behind it. Price moving up on strong volume usually means stronger buyer conviction. And if the price moves up on weak volume, it usually means the move is fragile, so be careful. And this matters even more in pre-market and after hours because one candle can look huge, but if barely anyone traded it, you need to be careful giving it too much weight. Now, volume is not a standalone indicator. It works best when it supports those 4 other signals. It tells the traders if the move was supported by real demand or if the price is just moving because of thin liquidity. Now that you know what these 5 indicators are telling you, the next step is having them readily available when you're analyzing a chart. That's exactly what we built Rift for. You can easily track all of these indicators in one piece without digging through complicated chart settings or paying to unlock basic tools. I talk all about indicators, signals, and all other features Rift offers in this video. It's linked in the description below. These 5 indicators are really powerful when they're structured together into one structured trading workflow. You use moving averages to understand direction and whether you're trading with or against the trend. You then use MACD to confirm whether momentum is building or fading. RSI can be used to spot exhaustion, divergence, and a possible turning point. Then you use ATR to help you set stops, size positions, and understand volatility. Finally, you use the volume surrounding the price to confirm whether the move is actually real. Each of these indicators are really useful, but just keep in mind, you always want to use them in context of the market and sector environment you're trading in. Inside Rift, these indicators are built directly into the charting experience, so you can pull up an asset, look at the trend, check momentum, measure volatility, see what's actually in play without jumping across a bunch of different apps. And what we're building towards is even more powerful than just showing individual indicators. You can use Rift signals, import your own TradingView signals, backtest them, track how they perform, and then automate strategies around indicators or signals that actually matter to you, all from a single app built for 24/7 markets. Rift is the only app designed specifically for after-hours, pre-market, and 24/7 trading. We built it so you could trade virtually any asset, anytime, anywhere. So if you want to start implementing these indicators and start making the most of them, you want to do them on Rift. Download Rift today, and I'll see you in the next one.